Hi, good morning. We'll start today's webinar. In today's webinar, we'll give updates on several counters, and we will also talk about the U.S., China, as well as the technical weekly outlook. So, firstly, we will talk about China Aviation Oil 2Q results update. We maintain our buy call with a lower target price of $1.52, and our previous target price was $1.67. The positives for second quarter was that the overall supply and trading volume improved mildly. This was mainly because of the better demand from Europe and China market. And meanwhile, gas oil volume also increased because of the substitute of fuel oil. Right now, the whole overall market is reducing the use of fuel oil because of the IMO regulation. So we can foresee that moving forward, the demand for gas oil will continue to improve. Another positive is that the profit contributions from Pudong grow moderately. This was mainly because of the ramp up of refueling volumes. You can see here it was about 16% year-on-year growth in second Q. However, the operation of the fifth runway in Pudong Airport has not fully utilized. So that means in the future, we will still see more room to grow the refueling volume when the fifth runway improve its utilization rate. The negatives for this quarter was that the surge in provision for expected credit losses, this was mainly due to one of the counterparty has higher risk in paying is the receivables owed to China Aviation Oil. As a result, the day sales in receivables increased by 2.5 days to 24.5 days. So moving forward, according to the management, this customer may still will face the deteriorating business operations. So the outlook for this counter is that the intensified China and US trade tension will continue, and also the global economic growth will slow down. So we foresee that this year CAO's performance will only have slight growth or even flat. Next is China Everbright Water. We maintain our buy call with an unchanged target price of 50 cents. The positives for this quarter was that it entered into a new business in a new province. China Everbright Water secured the water supply project in Zhejiang province, and this is the first provincial market for Everbright Water. And also they continue to expand the business scope to asset-light models because in first half of this year, they secured 2 engineering, procurement, construction, and 1 operations and maintenance projects. So these projects will enhance the ROE. And as of June 19, there were 40 projects in the pipeline. And in the first half, 8 projects received tariff hikes ranging from 4% to 56%. And as of June, the total design daily wastewater treatment capacity exceeded 6 million tons. So the outlook for this counter is that according to the management, the competition within the industry became less competitive, and also the projects are more reasonable. The variation of the projects are more reasonable now, so it will benefit the SOE such as Everbright Water to acquire more quality projects moving forward. So we still think that there is a robust and stable growing performance in the next couples of years. The next is CNMC Goldmine. We downgrade our call from buy to accumulate mainly because of the recent price appreciation, and our target price improved slightly to 33 cents. Our previous target price was 31 cents. So the positives for this counter was that the gold price right now is on the bull run after the rally back to a 6-year high. So it is worth noting that the gold price started to run at the end of June from 1,004 ounce per year, from 1,004 US dollars per ounce to right now about 1,005 dollars per ounce. So right now the gold price is still holding up. However, the negatives for this counter is that in second Q, CNMC has lower ore grade, so its production volume actually missed our expectation. However, so far all the output from CNMC were from open pit mining, which means that the ore grade from this pit is much lower than the underground mining. So since June, CNMC has conducted the underground mining. So in the second half, we expect that the higher ore grade will contribute to the top line accordingly. So this is the expansion plans for this counter. So there are two need to be pay attention. One is the embark on the underground mining, which has already started. And the second thing is the establishment of a new flotation facility to monetize on other minerals such as silver, zinc, and lead. So we expect that second half of this year, the high ore grade from the underground mining will improve the performance. And the next year, we expect the company will start to monetize on other minerals. So next year, we are looking forward to a new milestone for CNMC to improve the production volume as well as the overall financials. So next, I'll pass on to Natalie to talk about Dasin Retail Trust.
Hi. Okay, thanks for joining us. So are we going through Dasin's second quarter results? Dasin is covered under the Stock Facts program. It's a paid research program. So our call on Dasin is accumulate, unchanged target price of 94 cents. For Q2, the gross revenue fell by about 4%. This is due to the weakening of renminbi against Singapore dollar. And also, there was absence of revenue from an ongoing AEI at Xiaolan Metro Mall. MPI was 17% lower. This was due to higher operating expenses and stamp duties on lease agreements. So on the positive side, the AEI at Xiaolan Metro Mall, it involves 2,500 square meters of space. This is approximately 3% of the mall NLA. I would like to mention that Xiaolan is the second largest mall in Dasin's portfolio. This AEI will yield 15% return on investment. So a little bit of color on what's going on at this AEI. Basically, one of the tenants, restaurant tenant, gave up half the space, and this space will then be carved up into eight smaller F&B units. And Dasin expects to receive a 35% increase in rentals post AEI. So six of the new F&B's spaces have already been committed, and they've already commenced operation. So this AEI is slated to be completed at the end of 2019. So another positive is the portfolio occupancy increased 80 basis points to now 98.3%. What's worth noting is that for the past few quarters, actually, Dasin's portfolio occupancy has always been in around 99. Yeah, but in Q1, occupancy fell, so now it's coming back up. On the negative side, the valuations across all four malls fell by 1 to 3%. This resulted in a 21 million revaluation loss, and this was due to lower rental growth assumptions used by the valuer. So one way for Dasin to actually start to increase the value of their malls is first of all through AEIs. That will increase the net property income and lead to higher valuations. And another thing is that two of their malls are still relatively young malls. They are Ocean Metro Mall and Dasin E-Color. So these two malls will, with the passage of time, will start to stabilize, and that will also help with the increasing of valuations. Another negative is that the NPI margin fell. It is now at, for Q2, it's at 75%. So all along, Dasin has always targeted NPI margin of 80%. But this quarter, due to higher operating expenses, the NPI margin fell. So in Q1, just for some color, the NPI margin was actually around 84%. What else happened for Dasin this quarter? It was the proposed acquisition of Goldmine Metro Mall. So this mall, the agreed property value was 23% discount to valuation, and it's quite a sizable mall. So it will actually, as you can see from figure 2, originally the mall, the three largest malls contributed about 36%, and 22% to the portfolio. But with this new acquisition, we see a better balance or diversification of income between the four larger malls. So it's 21%, and the highest concentration is actually 29%. So it's lower from 36, almost 37%. Okay, so the three key benefits from this acquisition is, first of all, the DPU accretion, better income diversification, as mentioned, as well as an increase in NAV per unit. So if you recall, for Dasin, they actually have this special arrangement where two of the largest shareholders actually waive their rights to distribution, and there will be the number of units that have waived the distribution will actually decline all the way until financial year 2020. So at the end of 2020, all the units in circulation will be entitled dividends. So at currently in 2019, 69% of these units attributable to the two largest shareholders are not entitled any distribution. This is about 45% of all the existing units. So what this distribution waiver is supposed to do is to help to support the DPU. Okay, so currently the DPU with waiver is at 77.22 cents. So if you're looking at this pro forma impact of the acquisition of Goldmine Metro Mall, you can see that after the acquisition, actually the DPU with waiver is still unchanged. So there will be no impact to current shareholders. But what is worth noting is that the DPU without waiver currently is still almost half of what unit holders are receiving. So after the acquisition, the underlying DPU will increase by 12% to 4.3 cents. So this will actually help to close the gap between the underlying waiver and the underlying DPU and the DPU with waiver, so that it mitigates the DPU cliff in 2022. So moving on to CEWL REIT. CEWL REIT is also covered under our stock facts program, so it's paid research. I'll call on CEWL as a buy, and the current target price, the target price is unchanged at 87 cents. So for the 2Q performance, gross revenue fell by almost 5%. This is due to the depreciation of the renminbi against Singapore dollar. This is a translation loss. CEWL actually hedges 75% of their distributable income 6 months ahead on a rolling 6 months hedge. So in renminbi terms, the gross revenue actually increased by 3.6%. This is due to contributions from Wuhan that was acquired about a year ago, and built-in rental escalations. So the portfolio has rental escalations about 1 to 3%. So on the positive side, CEWL has a high portfolio occupancy of 99%, and actually 63% of the net property income, or NPI, is underpinned by master leases. So these master leases are two with a sponsor. and they have recently been renewed on the 3-year term. Another thing is that one of the specialized logistic assets, which is Hengte Logistics, it is leased out to a state-owned tobacco company, and this asset contributes 15% towards MPI, and basically we do not see any income risk coming from this tenant. So a lot of their income is actually secured. On the negative side, 2Q borrowing costs actually increased from 4.1% to 4.5%. This is due to higher interest and quantum on the standby letter of credit facility. Actually, post 2Q, they ECWL managed to refinance all of their expiring debt on a three-year term. Moving forward, we actually see that we would expect that the borrowing cost would be similar to previous quarters. So it was not disclosed what the final cost of borrowing would be, but the management guided that it will be similar to previous quarters. So for comparison, the 1Q interest rate was 4.1%. Sorry. So one last negative is that the occupancy at Wuhan fell by 13.8 percentage points to 85.8%. This is due to non-renewals. However, we take comfort that this asset is a very small asset. It only contributes 1.7% towards NPI. And as such, our portfolio occupancy is still relatively high at 99%. For the outlook, as mentioned, the ECWL managed to refinance 100% of their loans on the 3-year term. There is positive reversionary potential for 2 of their leases, which are currently below market rents, and they will expire in 2020 and 2021. So one of these leases is actually to the at the Hengte facility, which is the specialized facility leased out to the state-owned tobacco company. So actually, the tobacco company rents up most of the space in Hengte, but is divided between different leases. The second lease is to one of the anchor tenants at Wuhan Mail-Order, which is currently about 25% below market rent. So FX remains a tail risk, but ECWL hedges 75% of distributable income, and they use put spreads. So what basically happens is that they are willing to take on the interest rate fluctuations within a band, and any extreme interest rate movements against them or in their favor, they will not have exposure to. So this is basically a cost-benefit trade-off. The figure on the right actually just to show you how the Singapore dollar and renminbi currency pair have been trading. And even though in news recently it says that the renminbi crossed the 7 mark against the US dollar, for the SGD RMB pair, it's only been 2.1% year on year. Okay, so to wrap things up, just maintain a buy on ECWL, and it currently trades at 8.7% yield. Moving on to Edmund for ComfortDelGro.
Thank you, Natalie. So right now I'll be covering Comfort. So for Comfort, the positive is that their revenue and earnings have met our expectations. As for their revenue and their EBIT, they have grew by 8.5% and 15.8% year-on-year respectively, while operating margin have improved 8% in the first quarter of 19 to 8.7% in 2Q19. And this improvement is largely due to the contributions from the newly acquired bus businesses in Australia, and it is partially offset by meaningful FX losses and higher costs from the acquisitions. The Singapore bus business also saw higher mileage and contributions from new bus contracts, mainly from Seletar and Bukit Merah packages. For the negatives, then we still see headwinds from the higher operating and maintenance costs for rail operations, and this is mainly because as the NEL and the LRT lines move into their mid-life cycles, they will require higher repairs and maintenance costs. But one of the positives is that losses have narrowed for the TTL line as the number of ridership continues to grow. As for the taxi business, we still see intensive competitive pressures from the ride-hailing apps. As for the outlook, we believe that the focus for overseas acquisitions and bidding of new bus routes, especially in South Australia and Perth, will provide earnings upside. And we will expect that the narrowing losses from the real operations to continue due to a higher ridership and fare increases, though it will likely be offset by higher repairs and maintenance costs for LRT and MRT. The taxi business remains challenging, but we will think that there will be new business opportunities from the overseas expansion. As for Banyan Tree, their earnings and revenue did not manage to meet our expectations, and their revenue was down 24% year on year. The only positive is that there is still effective cost management across the board. Total costs and expenses were down 70% year on year. This is true for all the expense categories except for other operating expenses. As for the negatives, hotel investments continue to suffer from the Thailand underperformance, and this is largely due to the non-consolidation of the revenue from Seychelles, which they have divested in the previous quarter. There's also ongoing renovations at Banyan Tree Phuket, which was one of the main reasons for the weaker bookings as well. As for the property sales segment, it was down mainly due to the timing of the revenue recognition. So there were a lower number of properties recognized as revenue. A total of 7 units of Cassia Phuket, Cassia Bintan, and Laguna Park were recognized in 2Q19 as compared to 35 units recognized in 2Q18. As for the outlook, we believe that the underperformance in Thailand will continue to impede earnings, mainly due to the one-off events such as the inventory shortage at Banyan Tree Phuket. But that said, we expect earnings to recover once the renovations are complete. And also, there's going to be 9 new resorts that's going to be opened in the next 12 months. So that will likely boost earnings as well. As for the property sales side, there is total unrecognized revenue of 221 million as at end 2Q19. And management provided that some of these villas will be completed in 4Q19, which will allow the group to recognize revenue of about 84 million during that period. As for fee-based income, we believe it will continue to be the key growth driver as they continue to ramp up its China operations from its key partnership with Funke. And we also expect fee-based income to resume growth with 9 spas to be launched under management in the next 12 months. That is why we maintain our accumulate call for Banyan Tree with a lower target price of 0.51. Moving on to US weekly. The sector performance for US for the past week was not as good. Most of the sectors are down. This is mainly due to the inversion of the yield curve. So this is the list of the upcoming earnings release. Now I'll move on to Jerry for the China weekly.
We will give updates for the JD.com's second quarter's results. Overall, still we are positive on the JD.com because of the 3 reasons. We are seeing the strong revenue growth recoveries, also the margins improvement, and the active users has been stable. For the revenue side, we are seeing a strong recovery. Revenues grows 22% year over year to 115 billion RMB, and the key revenue drivers are at the advertising revenue growth, which accounted for 24%, and the JD logistics revenues also grows to 98% year on year. And also, based on the China's homes electricity research institutions, the data, the JD still remain the number one market shares with the market shares of 39.6%. We also see the improvement of the operating margins. Mainly because of there's a large orders coming from the lower tier cities to the third parties logistics and service. And for the logistics service, that it already turned loose into the profit. Also, there is the big increase on the JD's direct sales business. For the active users, JD's active annual active customers still increased to 300 million in the second quarters. And because of the JD says they are continue to try to attract more customers from lower tier cities by providing more service and product. While since the continuing the active users growth coming to the next quarter. For the stock performance, because of there is the few industrial policies coming last 2 weeks, where since there is a rebound on the China stock market, especially for the finance market and technology sectors. Because for China side, China announced that there will be interest policies effected from the August 20th. We are seeing there is the valuations, the corrections in the banking sectors. Also because of the new margin policies that come into the brokerage industries, we are continuing to see the business of the brokerage sectors continue to increase. This is the upcoming earnings released in this week. I will move on to Williams for the technical outlook.
Thank you, Zian. Today we'll share two stocks. One is JD.com and one is Starbucks. So let's move on. Okay, for JD.com, we are quite bullish as both descending Bollinger Wedge is over here. The weekly Bollinger Wedge and the ascending triangle are the key upside for breakouts. As for this falling Bollinger Wedge, price has already tested and did a breakout, but subsequently it retraced back. However, based on the new formation of the ascending triangle and the false breakout over here, morning star formation and the bullish pin bar above 50% is a strong indication that the stock will head for a bullish breakout at $35. As of current today, the price has already hit $31 near to the resistance of 31.75, and we expect the price when the US market open, you will get higher thereafter. So let's move on to Starbucks. So for Starbucks, we are still is a very strong market since June 2018. After a prolonged session of running flat corrective wave for 2.5 years to 3 years. Right now we are having a primary wave count and currently third wave has already been terminated. There's high chance third wave is already terminated because as it reached 161.8%. And another factor is the failure to meet $100 mark, psychological mark indicates a bullish exhaustion. Flat divergence and multiple oversold zones are also a key indication that that we are heading the fourth wave correction. And based on the Fibonacci of the third wave, retracement of third wave, there is a very strong demand level at the wave 4 area at between $80 to $84. So that's all. That's all of our presentation. Any questions so far?
For the questions, where to find the Chinese companies announcement and dividend news, like usually you can go to the Shanghai Exchange, website, also the Shenzhen Exchange website. For the Hong Kong shares, you can go to the Hong Kong Exchange website. You can Google the Shanghai Exchange or Shenzhen Exchange. I think the website for the website. Yes, for the questions of the STI in Hong Kong market and the Hang Seng Index, the answer is yes.
Hi, so we have some interest about Yangzhijiang shipbuilding. Unfortunately, we do not follow this counter, so we cannot give a comment. And with regard to the telco sector, our colleague who covers the telco, Alvin, he's not around. So we'll probably give an update next week.
For the questions of the Shanghai Exchange to provide to the financial screeners, for us, so far the Shanghai Exchange didn't provide the financial screeners. It only provides for exact companies the financial informations. If you are interested in the stocks, maybe you can go to the website like East Money website or some
or finance is INA, maybe you can find some informations. Thank you.
Okay, if there are no more questions, we'll end today's webinar here. Thank you for joining us today.